Silver did not become dangerous because it was weak. It became dangerous because it moved too fast, too clean, too confidently, and it started convincing ordinary people that the easy money phase had no ending. That is what this video is about. Not whether silver has value, not whether the long-term case is real, but whether a parabolic move can turn a smart thesis into a financial ambush. Because it can. It has done it before. And if you do not understand the pattern that appears right before the break, a winning position can become a life-changing mistake in a matter of days. There was a man who thought he was being prudent. He was not reckless. He was not the kind of person who chased lottery tickets or penny stocks or casino stories. He was careful, methodical. The kind of man who read everything twice, compared prices, kept records, balanced risk, and believed that discipline would protect him from chaos. Then silver started running, and within a few months all of that caution was replaced by one emotion he did not even recognize until it was too late: urgency. He watched the price rise day after day. He watched commentators explain why the old rules no longer applied. He watched charts go vertical and headlines grow louder. Inflation fears, currency fears, debt fears, monetary instability, safe haven demand, hard assets, real money. Everywhere he looked, the message was the same. This was not just another move. This was the move. The one people talk about for decades. The one you regret missing for the rest of your life. So he bought. Not a token amount, not a carefully measured position. He bought big enough that it mattered. Big enough that every new dollar in silver felt like proof that he was ahead of the crowd. At first, the market rewarded him. That is how these things work. The most dangerous trades are usually the ones that make you feel brilliant before they make you feel trapped. Silver kept rising. His account kept swelling. His conviction hardened. The people around him grew more interested. Doubters became believers. Even the little voice in his head that once asked cautious questions went quiet. Then the move became something else. It stopped looking like a climb and started looking like a launch. The pace changed. The candles got taller. The conversations got hotter. The forecasts got wilder. And instead of reading that as a warning, he read it as confirmation. He thought acceleration meant certainty. He thought the boiling point meant the heat would last forever. He did not understand that parabolic moves do not signal safety. They signal exhaustion. They signal crowding. They signal that the market is pulling future demand into the present and setting up the kind of vacuum that only appears right before air disappears from the room. Then came the first drop. It was not even catastrophic, just enough to make people uncomfortable. A quick hit lower, a normal pullback, a healthy pause. That is what everyone called it. That is what he called it too. The next drop was bigger, then another, then another. In less than 72 hours, a position that had made him feel secure had torn a hole straight through his peace of mind. Half the comfort was gone, half the confidence was gone, half the dream was gone. And what replaced it was not clarity, it was paralysis. Because when people imagine losing money, they picture a clean decision. They imagine they will calmly sell, protect themselves, and move on. That is not what happens in a real collapse. In a real collapse, the mind starts negotiating with pain. It starts telling stories. It says the market is irrational. It says the bounce is coming. It says selling now would make the loss real. It says smart people hold through volatility. It says patience will be rewarded. That is how temporary damage becomes long-term damage. Not because the asset changed, because the person holding it could not emotionally accept what the chart was saying. This man was not destroyed by silver itself. He was destroyed by the final stage of a parabolic move and by the lie that every parabolic move tells the people arriving late. The lie is simple. It says speed is strength. It says vertical means inevitable. It says everyone who hesitates will be punished, and everyone who acts now will be saved. That lie has emptied accounts in every market cycle for generations, and that is why this matters right now. Because whenever silver starts moving fast, the same psychological pattern returns. First, nobody cares. Then specialists care. Then believers care. Then opportunists care. Then the public notices. Then the public gets emotional. Then every conversation starts sounding identical. Triple digits, historic breakout, monetary reset, supply crisis, once-in-a-generation opportunity, no ceiling, no looking back. That is not the beginning of a move. That is usually the phase where risk becomes invisible precisely when it is expanding the fastest. Look back at any major parabolic market, and the structure is nearly always the same. There is a long, respectable advance that builds the foundation. It is not exciting enough to dominate dinner table conversations. It is not explosive enough to attract the last buyer. It is steady, logical, sustainable enough to appear trustworthy. Then comes the final phase. Price starts moving in ways that no longer match its earlier rhythm. The slope steepens. The daily swings widen. Confidence spills into certainty. And certainty is where danger enters. Because markets do not break when people are uncertain. They break when too many people become sure. That is what many investors fail to grasp about silver. A strong long-term thesis does not protect you from a vicious short-term unwind. In fact, sometimes it makes you more vulnerable. The stronger the story, the easier it becomes to justify ignoring risk. Silver has industrial demand. Silver has monetary appeal. Silver sits inside the inflation conversation, the manufacturing conversation, the energy conversation, and the fear conversation. That combination makes it powerful. It also makes it unstable when enthusiasm turns into obsession. When one asset is being pulled by macro fear, speculative momentum, industrial demand, and retail emotion at the same time, the chart can become violently deceptive. The rise feels justified. The narrative feels serious. The conviction feels intelligent. But the market does not care how intelligent the narrative sounds once positioning becomes too crowded. It only cares about who is left to buy and who panics first when price stops obeying the story. This is where the real trap opens. People think the danger is buying something worthless. Usually it is not. Usually the danger is buying something with a real case behind it at the exact moment that case has already been fully absorbed, overextended, and emotionally weaponized by the crowd. A good asset can still be a terrible entry. A legitimate trend can still produce catastrophic timing. And the harsher the move upward, the more people forget that distinction. Now let me show you the split that matters more than almost anything else in a market like this. There are two kinds of people in a parabolic run. The first type sees profits and begins planning how to protect them. The second type sees profits and begins mentally spending profits that do not exist yet. The first type asks, what if this reverses violently? The second type asks, what if I sell too early and miss the moonshot? The first type is trying to survive the full cycle. The second type is trying to maximize a single emotional high. Over time, the first type usually stays solvent. The second type usually becomes a story. That difference sounds small when price is rising. It becomes everything when price finally snaps. Imagine two holders. Both believe in silver. Both buy during a strong phase. Both watch the market move in their favor. One has rules. The other has hope. One decides in advance what percentage of gains will be taken if the move becomes stretched. The other decides to wait because the chart looks too strong to sell. One reduces risk into strength. The other adds conviction into strength. One is willing to look slightly foolish if the rally continues without them. The other is terrified of leaving money on the table. That fear of missing extra upside is what keeps people seated in positions long after the prudent decision has passed. The market punishes that fear with precision. Because here is the brutal truth. In parabolic environments, the people who often come out best are not the ones who sell the exact top. They are the ones who refuse to let a massive paper gain become a permanent wound. They accept imperfection. They accept that they will not squeeze every last dollar from the move. They accept that protecting capital is more important than winning arguments with the internet. They accept boredom over drama. That sounds almost too simple, but simplicity is usually what survives when emotion tries to take over. Most people do the opposite. They become more aggressive the more extended the move becomes. They tell themselves that a powerful trend deserves greater commitment. They start using phrases like, "This time is different." They start dismissing history because the present feels more convincing than the past. They start treating caution like weakness. But the market has no obligation to reward confidence simply because confidence feels good. When an asset goes parabolic, your emotional comfort is often peaking right as the fragility of the move is becoming extreme. That is why the final stage is so seductive. It gives you profits fast enough to numb your risk senses. Then comes the question nobody likes to answer honestly. If the silver position you hold right now dropped hard and fast, how much pain would it actually cause in your life? Not on a screen, in your real life. Would it change your sleep, your bills, your retirement timeline, your ability to help family, your level of stress at dinner, your sense of control? If the answer is that a sharp drop would truly damage your stability, then the position is not just an investment anymore, it is a threat. And threats dressed up as opportunities are the most expensive kind. A lot of people confuse conviction with concentration. They are not the same thing. You can believe in silver deeply and still refuse to let it dominate your future. You can think the long-term setup is strong and still admit that the short-term chart has become overheated. You can participate and still protect yourself. The crowd acts like these choices are incompatible. They are not. The crowd just prefers absolutes because absolutes are emotionally satisfying. But markets do not pay you for emotional satisfaction. They pay you for discipline. So what does discipline actually look like when silver is flying and everyone around you is getting louder? It means taking a hard look at open profit and asking whether you have mistaken temporary momentum for permanent wealth. It means deciding in advance what portion comes off if price extends too far too fast. It means refusing to add heavily just because the chart makes you feel late. It means understanding that the best time to create an exit framework is before you need it, not during the panic. It means accepting that some cashing out into strength is not betrayal of the thesis. It is respect for uncertainty. And if you are not in yet, discipline means something even harder. It means refusing to chase a vertical move simply because the story around it sounds irresistible. Chasing is rarely admitted for what it is. People rename it conviction. They rename it urgency. They rename it responsiveness to a historic setup. But underneath all of that, chasing is still just fear wearing a smarter suit. Fear of being left behind. Fear of watching others win. Fear of missing the headline move. Fear is a terrible portfolio manager. You need rules before emotion shows up, not after, before. At what point does a gain become large enough that you scale some out? At what point does a loss become a message rather than a temporary inconvenience? How much of your total financial life is allowed inside one volatile asset? What exactly is your reason for owning silver? Is it insurance, speculation, inflation concern, industrial upside, momentum? Because if you do not know why you own it, you definitely will not know what to do when it stops behaving the way you expected. That is where people get trapped. They own one thing for 3 different reasons at once and end up with no clear response when price moves against them. If silver is your insurance, you do not treat it like a momentum trade. If it is your trade, you do not defend it like a family heirloom. If it is your long-term allocation, you do not pile into it like a short-term gambler at the exact moment volatility starts screaming. Clarity about purpose is what keeps one position from becoming 4 conflicting identities inside your head. And this is the part that really matters. The market will almost always give you another opportunity, another entry, another correction, another cycle, another setup. What it may not give you back is the capital you lose because you were determined to squeeze out the final emotional thrill of a crowded move. Missing some upside is survivable. Losing a huge chunk of hard-earned savings because you refuse to believe a parabolic chart could break is far harder to repair. That is why the old pattern matters so much. The pattern is not just about price, it is about behavior. Long rise, sudden acceleration, mass attention, extreme certainty, violent reversal. Rationalization, prolonged regret. Once you see that pattern, silver stops looking like a one-directional promise and starts looking like what it really is during these moments. A powerful asset capable of rewarding discipline and punishing emotional overreach with equal force. So be honest with yourself. Are you building a plan, or are you building a story? Are you protecting gains, or are you fantasizing about gains that have not happened yet? Are you participating in silver, or are you slowly allowing silver to dictate your peace of mind? Because in the end, that is the real danger of a parabolic move. Not just that the price collapses, it is that the collapse arrives after the asset has convinced you to attach your identity, your certainty, and your future to a line on a chart that never owed you loyalty in the first place. If you already hold silver, this is the time to get serious, not emotional. Tighten your framework. Decide what you are willing to protect. Decide what you are willing to risk. Write it down before the next wild move makes thinking difficult. If you are considering buying, do not enter like someone being chased. Enter like someone who expects volatility, respects history, and plans to survive no matter what the crowd is shouting. Small size is not weakness. Scaling is not weakness. Taking partial profit is not weakness. Sleeping at night is not weakness. The people who last in markets are not usually the people with the loudest predictions. They are the people who understand that survival is a strategy. They know that one asset should never be allowed to write the entire story of their financial life. They know that a market can be right in the long run and still brutal in the middle. They know that discipline feels boring right before it feels brilliant. Silver may still have more upside. That is possible. It may even shock people with how far it can run. But none of that changes the core warning. When a move becomes parabolic, your biggest enemy is no longer the market alone. It is the version of you that starts believing the market must continue because it has already rewarded you. That is the moment to get careful. Do you think silver is setting up for another dangerous blow-off phase? Or do you think this move still has a lot more room before real risk begins? And if you were sitting on a large silver profit today, would you take some off the table or keep riding it? Subscribe if you want more sharp market breakdowns like this.